Hi, my name is Christina Brown and I am a mortgage loan officer here at People's Mortgage. I just wanted to talk to you a little bit today about the basics of doing a mortgage and going through the mortgage process. And I wanted to explain a lot of the terminology that's used and the processes that you'll undergo. I don't think a lot of times that these things are explained to borrowers before they go through the process. So I would hopefully, it is my intention that this will clarify things and make the process much smoother and easy to understand. First of all, I would like to talk about what is a pre-qualification as opposed to a pre-approval. A pre-qualification means that the borrower is qualified on the basis of filling out a loan application, checking their FICO score, checking which is their credit, calculating their debt-to-income ratio, going over the preliminary numbers of the loan, and running it through an automated desktop underwriting system. A pre-approval is backed up by all the necessary documents that the pre-qualification process requires. It's backed by taxes, bank statements, things like that, pay stubs, all the necessary documents needed to verify the pre-qualification and submit the loan into processing once there is a real estate purchase contract involved. What is rescoring? If a borrower has a low FICO score or a high debt-to-income ratio, they can get a game plan in place with their loan officer. This process of rescoring is to raise their credit score and pay off debt in a quick, efficient, and educated way. The loan officer checks their credit, figures out what accounts need to be paid down to what amount, and how much debt needs to be paid off in order to qualify for the purchase price of the home that they're interested in. What is a debt-to-income ratio? Debt-to-income ratio is your income divided by your debt. So say you make $10,000 a month and your debt is $5,000. The money that you pay, your rent, all your bills, things like that, then your debt-to-income ratio would be 50%. For most mortgages, that debt-to-income ratio limit is 45%, 50, and 56%, depending on the strength of the borrower's financial profile. There's a lot of assets or money in the bank. The debt-to-income ratio on certain loans, say FHA loans, can be higher than, sometimes they're even approved. I've seen them approved at 57%. So it just depends on the borrower. You don't usually want to go up that high, but this is a great example of how a debt-to-income ratio is calculated and how it works. What is a FICO score? A FICO score is the way a mortgage credit score is calculated. It's different from the way a credit score is calculated when applying for an auto loan. A FICO score is going to be the mid-score in between the three credit scores, and if there are two FICO scores, it will be the lower that is calculated. What are closing costs? Closing costs include your new home's title fees, and then also your escrow, which are your property taxes, your homeowners association fees, and your homeowners or hazard insurance. And it's also several months in advance put into a cushion and calculated into your loan, and that is standard for most loans. Fees, the cost that it takes to do the loan from your mortgage company is included, which include origination fees, processing fees, title fees, and administration fees. Essentially, the costs of financing your loan. Finally, the closing costs will include your appraisal cost. If it's not paid up front at the time of the appraisal, a lot of mortgage companies will have you pay the appraisal at the time of the appraisal as opposed to including it in your closing costs, because the appraisal company wants to get paid in order to have an appraiser go out to the property and generate an appraisal. So anyway, I hope this clears things up in the home buying and financing process. If you have any questions at all regarding buying a home or how this all works, please give me a call at 801-554-4084 or email me at christinab@peoplesmortgage.com. That's KRISTI.